Hello everyone. In this particular recording, we're going to go through some of the homework problems in Chapter 3. Now remember, Chapter 3 was all about CVP analysis, as well as some sensitivity analysis that we did as well, like margin of safety and operating leverage. And one of the key components of understanding CVP analysis, of course, is understanding this concept of contribution margin and using the contribution margins to figure out break-even points in units, break-even points in revenue dollars, as well as target profit points. And so the first homework question, we are actually going to figure out the break-even points in units as well as revenues. So what was given to us is the selling price. We do window installations. So the selling price for each of our installations is $400. Our variable cost per installation is $200. And our total fixed cost, regardless of activity, remember that is the main concept of a fixed cost, it remains the same in total, regardless of activity, is $160,000. So we first need to figure out what is the break-even point in units. And there is a formula that helps us figure out what the break-even point in units is. And that is as follows. Your numerator is your total fixed costs, which in this case is $160,000, divided by your denominator, which is your contribution margin per unit. Now remember, the contribution margin per unit is your selling price per unit minus your variable cost per unit. In this case, $400 minus $200 gives you $200. If we take 160,000 divided by the 200, we get our break-even point in units of 800. And if each 800 units cost $400 installation, the break-even point in sales dollars is $320,000. So this is kind of just a very simple exercise in understanding the break-even points. We're going to twist it a little bit and say, hey, you know what? On top of breaking even, I want to earn a target operating income of $280,000. Well, to answer that what-if question, you are simply going to add the target profit to the fixed costs in the numerator. Once you do that and you follow through, the denominator is still contribution margin per unit. We will get the number of units required to be sold at our target profit point. All right, so that's all you simply have to do. And take that new number, 2,200, divided by or multiply it by the sales price, and that is your revenue that you would need to obtain in order to get a target profit, in this case, $280,000. Okay, so little break-even analysis here, a little target profit analysis. In the next homework question, it's a little bit different because instead of targeting a certain operating income, we are targeting a certain net income. And remember, the big difference between operating income and net income is your tax expense. So when we're trying to figure out target net income, we always need to know what our tax percentage rate is. In this case, it's 40%. So we need to calculate our number of windows we must install in order to earn a target net income of $84,000. So before we do that, we need to take this target net income of $84,000 and divide it by 1 minus the tax rate. If the tax rate is 40%, 1 minus 40% gives us 60% or 0.60. In other words, in order to receive a target net income of $84,000 with a tax rate of 40%, that would be the same as obtaining a target operating income of $140,000. 84,000 divided by 0.60, 140,000. From there, we know the formulas. Your numerator is going to be your fixed costs, which was given to us in the problem, 165,000, plus your target operating income, which we just figured out. So if we add those two up, divided by your contribution margin per unit, which is the selling price per unit less the variable cost per unit, 450 minus 250 equals 200. And we know in order to earn a target net income of 84,000, we would need to sell 1,525 installs. All right, and if each install is $450 times 1,525, our target revenue, in order to get target net income of 84,000, we'd need a target revenue of 686,250. Okay, so that was break-even analysis and target profit analysis using operating income and net income numbers. Now what we're going to do here is we're going to calculate what's known as margin of safety. Basically put, the margin of safety is the difference between the actual revenue or the budgeted revenue minus the break-even revenue. The larger the margin of safety is, the healthier our company is. All right, so the information given to us, I'll put it out here on the right. We know that our selling price for each installation is $850. Our variable cost is $750. That would give you a contribution margin per install of $100, $850 minus the $750. And our annual fixed costs are $195,000. And so our break-even point, we know, in revenues is $1,657,500. Our break-even units is 1,950. What would the margin of safety be in dollars and percentage if we expect to sell 3,200 windows in the year? Okay, well, what would the budgeted revenue be? That would be the 3,200 times 850. If we take the 3,200 times the 850, you will get budgeted revenue, $2,720,000, minus the break-even revenue, which we stated earlier, $1,657,500. The difference between your budgeted revenue and your break-even revenue is the margin of safety in dollars. So, what about the margin of safety in units? Well, it would be the budgeted units. In this case, we want to sell 3,200 units. How about break-even units? We said in the problem it was 1,950. So the difference between budgeted units and break-even units gives you the margin of safety in units. So how about the margin of safety percentage? It's simply going to be the margin of safety in dollars divided by your budgeted revenue, 39.1%. Obviously, the higher the margin of safety is, the higher the margin of safety percentage will be as well. So once again, margin of safety is good to calculate because it shows how far away you are from the break-even point. The further away you are, on the positive side, of course, the healthier the company is. Okay, this next homework problem, we're going to concentrate on something called operating leverage. With operating leverage, it basically shows to you how sensitive changes are to sales based on our proportion of fixed costs. The higher proportion of fixed costs, the more sensitive changes are going to be to sales. So let's take a look at this example here. We have a company. They are considering changing its sales compensation for the year. Drayton would pay salespeople a 2% commission next year and reduce fixed selling costs by $63,000. So basically what the company is trying to do is we're going to try to change the way we pay our salespeople. We're going to pay them a commission now instead of paying them a fixed salary per se. All right, so what would the operating leverage be at 1,925 units under the two options? And once again, the operating leverage formula is going to be your contribution margin divided by your operating income. So let's take a look at option 1. With option 1, there's no commissions. The selling price was given to us, and I have that over here in the table on the right. The selling price is $700, and that's the same whether we give out option 1 no commission or option 2 commission. The variable cost was $500 with no commission. But if we give out a 2% commission, what is 2% of $700? 2% of 700 is $14. So we're going to add a $14 commission as part of our variable cost. So our variable cost is no longer $500 per unit, it's now $514. Selling price less variable cost gives you contribution margin per unit. All right, and then of course, when we have 1,925, 200 times 1,925, that'll give us our contribution margin. With the 2% commission, 186 times 1,925, you can see the contribution margin is lower. But what is the trade-off to that? The fixed cost with no commission, as we were told in the far right-hand side, 165,000. But with the 2% commission, what did we say we would reduce selling costs by? And I'm highlighting it up here. If we had the 2% commission, we're going to reduce selling costs by 63,000. So fixed costs are no longer 165,000, they are now 102,000. 63,000 less. Now if we subtract the fixed cost from the contribution margin, we get operating income. You can see using the 2% commission model, we should have higher operating income at this level. And the degree of operating leverage, once again, is simply going to be your contribution margin divided by your operating income. When we have higher fixed cost, as we do in option 1, your degree of operating leverage is going to be higher, which means that increases in sales, or decreases in sales, but for that matter, are going to be have more effect one way or the other on the operating income. All right, this homework problem is interesting because this homework problem takes into consideration a mix, a product mix. Now, doing break-even analysis or target profit analysis with a product mix, we first have to consider what we call a bundle. So let's take a look, and I'm going to click on the icon here. And basically what this gives us is right now, our expected sales are 4,400 for our first product called Chad windows, and for Musk windows 2,200. And we have a total. Chad, if we take Chad 4,400 out of the 6,600 and Musk 2,200 out of the 6,600, that means for every 2 Chad windows that we sell, we're going to sell 1 Musk window. Think about it. If you take 1 Musk window, 2,200, and you double it, you get the expected sales of the Chad windows. So for the bundle is going to be, and you can see it here, the bundle, for every bundle, we're going to have 2 Chad windows and 1 Musk window. So we're still calculating the bundle here. So for Chad, 2 windows. And what is our contribution margin per unit for Chad? Well, we have, let me see, for Chad, we have $850 in revenue and variable cost of $750. What's $850 minus $750? That is $100. So 100 times 2 is $200, which is the contribution margin for the bundle. How about the Musk windows? Selling price is 600. The variable cost is 550. So 600 minus 550, that's 50. 50 times 1 in the bundle, that gives you contribution margin for the bundle of 50. Add that to the CHAD windows, we get a total contribution margin for the bundle of 250. So now we can go ahead and utilize the formulas that we learned to figure out the break-even point for this particular bundle. And if you recall, the bundle for the break-even point is as follows. The numerator is going to be the fixed costs. Well, the author gave that number to us already, $185,000, divided by the contribution margin per the bundle, which we just calculated at 250. 185,000 divided by 250, that gives you 740 units in the bundle is your break-even point. And if you recall, the break-even point of 740 in the bundle, okay, 740, remember each bundle has one must window, so 740 times 1 is 740, and each bundle has 2 CHAD windows, so 740 times 2 is 1,480. 2,000, if you add the 2 up, 2,220 is the total number of units to break even. Okay, and once again, CHAD, 1,480 if the selling price is 850. 1,480, which we received up here, times 850 that was given to us. There's the break-even point in dollars. And the Musk windows, 740, which we calculated, times the selling price, which the author gave us of 600, equals 444,000. So combined, $1,702,000 is the break-even point for this particular product mix. And remember, once the mix changes between CHAD and Musk, say if we sell more or less CHADs compared to Musks, this bundle is going to change. And of course, the break-even analysis will change as well. And last but certainly not least, let's take a look at this last exercise where we are required to compute our income statement, which we see here. I'm sorry, the income statement. Clicking on the wrong item. Here we go. The income statement, let me put it out here on the far right. This is an income statement for accounting, for GAAP purposes, where we are utilizing the gross margin. Revenues less cost of goods sold. Remember, the cost of goods sold includes all of the manufacturing costs, whether they are variable or fixed. The revenues less your cost of goods sold gives you gross margin. From the gross margin, we're going to subtract out our fixed and variable general administrative expenses, and it gives us operating income. So basically what we're going to do is we're going to restate the accounting income statement utilizing the contribution format income statement. We are assuming that the same number of units produced is the same number of units that we are selling. Okay, so what we're going to do is the units sold are still the same 10,000 and produced the same 10,000. Revenues you're going to see are the same, 150, 150. Okay. Now what differs is instead of subtracting cost of goods sold to calculate gross margin, we are going to calculate all of our variable costs to calculate not gross margin but contribution margin. Our variable manufacturing costs are 65,000, which we see over here on the right-hand side, 65,000. But the variable administrative expenses are down here, 23,500. If we add them up, 88,500, subtract it from revenues, you get contribution margin. And from the contribution margin, you're going to subtract out all of your fixed costs, both the manufacturing and the general administration. You can see the top number and the bottom number are the same. It's just how we analyze the middle that is a little bit different with the contribution format income statement. And once again, the gross margin, the accounting income statement is required by GAAP. for external financial statement purposes, but for internal analysis for the managerial accountant, the cost accountant, the contribution format income statement is better. All right, now we are to prepare. Requirement 2 is to do the break-even point. So what we're going to take a look at is your numerator is your contribution margin. All right, we talked about that all the time. Divided by revenues, and that gives you your contribution margin percentage. All right, 41%. All right, keep that in mind. Now, the break-even point, the formula, the numerator is your fixed costs divided by your contribution margin per unit. $6.15, the contribution margin per unit. Okay, and we can see that if we have 61,500 divided by 10,000 units, that gets you the $6.15. So fixed cost divided by the contribution margin per unit gives me the break-even point in units, 7,100. How about in revenue dollars? It's going to be, your numerator is the same fixed costs, but your denominator is not going to be the contribution margin per unit. It's going to be the contribution margin percentage, which we calculated above as 41%. 43,665 divided by 41% or 0.41, you get 106,500, which is your break-even point in revenues. How about margin of safety? The margin of safety is the difference between the actual or the budgeted sales, in this case we're dealing with actuals, minus the break-even point. So the actual sales level we said was 10,000 units, and we just calculated a few seconds ago that the break-even point in units was 7,100. The difference is 2,900 units. That is the margin of safety in units. All right. And last but not least, let's take a look at the last requirement. Compute the table below to calculate DIVA's net income if sales were only 8,500 units. All right, so the contribution margin, remember we said before it was $6, I believe it was $6.15. So if we are selling 8,500 units and multiply it by $6.15, that gives us our contribution margin. Minus the fixed costs. Remember, the fixed costs, they stay the same. And we said the fixed costs are $43,665. They remain the same regardless of activity. Your margin, contribution margin minus your fixed costs gives you operating income. Operating income is $8,610. And if the sales tax rate is 30%, we will take that $8,610 and multiply it by 30%, and we get our tax expense of $2,583. Subtract that from your $8,610, and you are left with your net income of $6,027. And once again, all of these analyses are possible because we know how our costs behave. Once you know how your costs behave, variable cost and fixed costs, all of these analyses become a lot easier.